not in class today. We had depreciation, and I really need for you guys to attempt the practice paper that I put out on WhatsApp and on Google Classroom. Okay, so I'm going to do the depreciation session here. I don't know how the audio will sound, but I'm still going to go ahead with this. Okay, so this is how the slides began for depreciation, showing assets. The assets that you see here are, well, a new chest of drawers and some old chest of drawers. So obviously here we are talking about the new chest of drawers costing, let's just say, $10,000. And after a few years, this chest of drawers would no longer be the same value. It's not going to look the same. It's not going to have the same value. So if you have to cost the same chest of drawers 5 years later, and it looks like the picture on your right, then you'll probably say that's worth $500. So for the 5 years that you used this chest of drawers, you took it apart, you made several little units of it, and it got worn down. So now it's worth $500. So therefore now, the value that you received from it over the 5 years will be the $10,000 minus the $500. So the chest of drawers depreciated by $4,500. So it's the reduction in the use of a fixed asset. So let's move on. Depreciation is our topic. What is it? What do we have to learn? We have to learn what is the definition of depreciation, what causes depreciation, and we have to learn the two different methods of calculating depreciation. Hopefully, we'll be able to do the journal entries and the provision for depreciation. But that, I want to do those things with you over the holidays in terms of the journal entries and the ledger accounts for provision for depreciation. That would not be in your exam. Okay, so what is depreciation? So you saw the chest of drawers, you saw the new chest of drawers, and then you saw the old mashed up worn down chest of drawers. So what is depreciation? And I'm going to just break it down because you could read these slides, you could rewind this video when you want. Okay, depreciation is simply the part of the cost of a fixed asset that is consumed over a period of time. Right? And how does an accountant treat with that depreciation? It is an expense, and it will be found in the profit and loss account with the other expenses like rent and insurance and electricity. So it reduces the profit of a business. What causes depreciation? What causes a chest of drawers to look like that after 5 years? If you have a new vehicle, a vehicle that is off the showroom versus a vehicle that you have driven for 10 years, it's not going to be the same. What could happen to that new vehicle? You could get in an accident, you could get in a vehicle accident, and that will reduce the value of that car, right? It could just, by driving the vehicle, it would have been worn down. The tires would not be new. The suspension will be damaged. Brakes will have to change over time. It may rust. You might go on the beach, and the salt from the beach area will cause some rust in your vehicle, right? Now, depreciation, and I'll give you here the different reasons for depreciation as outlined in your syllabus. So we have different ways that assets can be depreciated. So the first one will be relate to forests and natural resources, land, quarries, forests, mining lands. People take minerals from the ground, and the land no longer has the same value from when they had started. So for natural resources can be depleted. Then you have things like copyright. So if you invent something, let's just say you invented a innovative pair of sneakers that could actually lift you off the ground, you only have 20 years that you can use that patent, that right for that brand that you give to that sneakers. After that, it's free for all. So it will depreciate. Your brand will depreciate because other people can start using your brand. So depreciation can occur over time, efflux of time. Then it physically deteriorates, just like the chest of drawers, rust, erosion, wear and tear. Every time you slam the door, you're shaking up something in the chest of drawers. Obsolescence. a cell phone from 15 years ago wouldn't work today, right? So look at the thing. So efflux of time with land and quarrying, physical depreciation in terms of physical deterioration in terms of a vehicle. It once was new, is no longer so new. You have accidents, and then you have a new phone versus an old phone. The old phone is no longer up to date, it's out of date, it's obsolete. Okay, what is the importance of calculating depreciation? And you will read this part because you don't get it very often, but really you need depreciation because your assets don't stay the same in real, and therefore in your accounting records you cannot leave your vehicles value the same. So you have to make an account or a record for depreciation in your final accounts. What depreciates? In accounting specifically, we look at fixed assets. Fixed assets is what depreciates, not your current assets, right? And depreciable assets, which are normally fixed assets, are expected to be used in your business for more than one accounting year or one accounting period. It has a limited useful life, but it tends to last for more than 1 year. It's held for the production of goods and services like your motor vehicles, your equipment, your premises, tools and equipment. Those things depreciate in your business. So in other words, fixed assets are what are depreciated in your accounting records. Methods of calculating depreciation. So we reach here already. There are two methods of calculating depreciation. You have the straight line or fixed installment method, right? And under that method, you can calculate the straight line method using the formula, or you can calculate the straight line method using a percentage, but it's still one method, just two different ways of calculating it. The second method, and as I said, there are two methods, not three. So the second method is the reducing balance method or diminishing balance method, which is the use of percentages. And you will see that hopefully in this video, or I will send another video for you. So let's go. The straight line method. The straight line method, also called the fixed installment method, right? Because every year your depreciation will be the same, right? Every single year your depreciation charge will be the same, it will be fixed. It's just like your parents go and borrow a loan. They're not gonna pay 500 one month and then 10,000 another month and then 3,000 another month. They're gonna pay 1,000 every month for 3 years or whatever the duration of the loan is. So what is the formula for the straight line method? We have here the depreciation charge per year is the cost price of the asset minus whatever you're going to sell the asset for at the end of the time you're going to use it for, or disposal value. And sometimes they say disposal value, scrap value, residual value, same thing, right? Same thing. So scrap value, disposal value is just the price that the firm will sell the asset after using it for a number of years. And then you need to also know the number of years that you're going to keep the asset for. So if you're going to keep it for 4 years, 3 years, 5 years, that is the how long you're going to keep or use the asset for in your business. The second way you calculate the straight line method, we're still on the straight line method, is when you actually find a percentage of the cost price of the asset. And we'll see that in probably another video. So let's move through this quickly. So we have here, and we're looking at the right here for the information, because you can get a question and it would look like this. They'll give you information like this. Company PQR bought a vehicle for $22,000 and decided to keep it for 4 years and then sell it at the end of the 4 years for $2,000. How are you going to calculate the annual depreciation charge using the straight line method? I'll say SLM, right, for straight line method. So this is it here. You're going to use the formula. Cost price minus disposal value over the number of years of use. So it would be $22,000 minus 2,000, your disposal value, how much you intend to sell it for, over the number of years. So when you get 20,000, 22 minus 2,000 is 20 over 4. You will get the depreciation charge being $5,000 for each year. So it's 5,000 for year 1, 5,000 for year 2, 5,000 for year 3, and 5,000 for year 4. So each year that vehicle is going to reduce in value by $5,000. Yes, so let's show it in the workings, right? Oh, have some terms there. I'll get back to that. Okay, yeah, look at this example here, how depreciation works. You have a vehicle here that is worth 4,000, and using the straight line method, the depreciation charge is 1,000 for each year. So at the end of each year, the vehicle is now worth 1,000 less, 1,000 less, 1,000 less, until the end of the 4th year it's worth 0, right? 4 years, 4,000.